No, I think it absolutely makes the market vulnerable because the way I think about it is as follows. The Fed balance sheet expanded from about 4.2 trillion to 7.2 trillion in just 4 months, went up $3 trillion. Now it's starting to shrink. And if you look at prior periods of time, like in 2011 or 2015 or 2018, when they talked about shrinkage, and I've got a chart of this on my website, danniles.com, that you can go to, you had big drops in the market during those periods of time. And so you combine that also with the fact, and you started the segment with, how much GDP had dropped. It's down over 30% in the US. Valuations are at all-time record levels. If you look at it from a total market cap of the entire United States stock market divided by GDP, that's at about 1.6. The 50-year average is 0.8, so 50% lower. So all of those things combined make the market pretty risky, which is what you referred to. So I'm very balanced in terms of I got a lot of shorts and I've got a lot of longs, and I'm rebalancing those daily based on how they're moving.
So my follow-up would be, how vulnerable does it make the markets? I mean, how much downside would you believe does it open for the markets? And to that point about that ratio of market cap to GDP, we've been there before, Daniel. Even in the previous cycle, the market cap to GDP was hovering anywhere between 1.4 to 1.5, and yet the market was holding up. So I just want to get your sense on what will tip the market, and if we do see the markets go down from here, how much would it be the fall?
Well, I look at history as a judge of that. And if you look at 2011, when the Fed stopped, hinted at not expanding its balance sheet, the market dropped about 19% over 5 months. If you look at 2015, when they talked about balance sheet shrinkage as well, the market dropped about 12% in just a month. And in 2018, which is obviously people remember, the market almost went down 20% in 3 months. You've obviously got a contentious election coming up. The rhetoric against China is probably going to continue to heat up. And so that's the type of range in my mind in terms of downside risk that's potentially possible given where we are. And don't forget, fundamentally, economies are shutting down again. California is, gone backwards to some degree. Stores are closing again that had opened up. Apple had all their stores open, then now they've closed some again. And so, you look at infection rates, hospitalizations, et cetera, the data is not great. The only thing really holding this market up to a large degree is the US federal government and the $600 a week, which makes 2/3 of people who are unemployed have more money now than when they had a job. And then, of course, the Federal Reserve, and as I talked about, they've started to shrink their balance sheet over the last 6 weeks. So that's how I think about that together.